In this video, I'm going to talk about theta. Time is money. So what is theta? If you recall, options are depreciating, wasting, or decaying assets because they have an expiration date. Since options have an expiration date, the closer the option gets to this date, the less valuable the option becomes. The value of an option decreases as time passes. This means that time is literally money with options. So here's the textbook definition. Theta, also known as time decay, is the option Greek that quantifies the option's sensitivity to time, and it's measured in dollars. The textbook definition: it is the amount the price of calls and puts will decrease, in theory, for a one-day change in the time till expiration. Think of theta like this. Theta in options trading can be likened to a melting ice cube, where the options value gradually diminishes over time, similar to how an ice cube slowly melts away. Another metaphor is an hourglass with sand. As each grain of sand falls, it represents the passing of time and the decreasing value of an option. Much like theta erodes the option's value as expiration approaches. The characteristics of theta. So calculating theta, it's typically given in dollars and cents. So for example, theta of minus 0.5 means the option price will decrease by 5 cents per day. This value can change, of course, as market conditions fluctuate. Magnitude of theta. Theta is typically larger for at-the-money options because they have the most extrinsic value, and it's smaller for deep in the money or deep out of the money options since they carry less extrinsic value. Time acceleration. Theta becomes more linear the further in the money and the further out of the money the option is. It's a misconception that as you approach the expiration date, that theta increases with all options, meaning that the rate of time decay accelerates, especially in the last 30 days. This acceleration decay in the last 30 days is for options at the money. So options traders that trade options at the money often monitor their positions more closely within the last 30 days to consider adjustments as expiration nears. So recall, options consist of extrinsic and intrinsic value. So extrinsic value consists of time value and implied volatility, which is sometimes factored into time value, but I've separated it here for learning purposes. The time value of an option is the portion of its price that exceeds its intrinsic value. Options are depreciating assets, which means as time goes by, they lose value, all else being equal. As time gets closer and closer to expiration, the time value decreases, negatively affecting the option price. And this is why options are called depreciating assets. The common misconception, time decay occurs at an accelerating rate. Back to the ice metaphor, the passage of time can be likened to the impact of a hot summer sun on a block of ice. With each passing moment, just as the sun causes the ice to melt, the time value of an option erodes. This erosion occurs at an increasingly acceleration rate as the expiration date draws nearer for certain options, but not all options. This is at the money theta depreciation. So these are options that are at the money, and you can see that the depreciation occurs towards the end of its life, like the last 30 days. So let's talk about theta and DTE. So with theta and days until expiration, as you do get closer to expiration, your theta does decrease more rapidly. Again, it's for at the money options. So the further you get out of the money, the more linear that becomes. So technically, when people say, yes, as you get closer to the expiration, your theta tends to get larger and larger, that is technically correct, but you have to also take into account how close are they to the money? Because if they're further out of the money, that is much, much lesser of a factor. That acceleration in depreciation is what I'm talking about. So theta's effect on option pricing is more pronounced for options with shorter term expiration compared to those with longer term, of course, at the money. And this is because at the expiration date of an option, as it gets closer, the rate of decay increases for short-term options. Each passing day represents a larger percentage of the option's remaining life, hence the value of the option decreases more rapidly. And in contrast, for long-term options, the impact of each passing day is less significant in the early stages of the option's life, resulting in a slower rate of time decay initially. Of course, again, for at-the-money options. As you get further out of the money, we'll talk about that. So theta decay and moneyness. Theta decay for at-the-money options. You can see this curve, and this is what I was talking about, that you can see once you get to the last 30 days, all of a sudden you fall off the cliff, okay? But that's for at the money. So you can see the acceleration or the rate that the option is depreciating happens much faster at the end of its life for at the money options. Now, since theta represents the rate of decay of this time value, at the money options typically experience more significant dollar losses over time. The larger portion of time value in these options means that there's more to lose as expiration approaches. And a lot more people sell at the money options or trade at the money options than they do out of the money. There's a lot more volume there. Now here's the theta decay for out of the money options, right? So if you're out of the money, look at how it's a straight line here. So you don't get to that last 30 days and fall off a cliff or anything. It's just a very linear depreciation. So while out of the money options have lower theta in absolute dollar terms, this loss can be more substantial in percentage terms. Yes, so the percent terms are higher, but again, it's more linear. And this is because the overall value of out of the money options is lower, mainly consisting of time value. As a result, even a smaller dollar loss can represent a significant portion of the option's total value in terms of percentages. Now here's the theta decay for in the money options. In the money options that have intrinsic value in addition to time value. That's what in the money options have. And they're less affected by theta in terms of the total option value, right? So they're in the money, so they're more affected by the price of the underlying than they are the extrinsic value of the option or the time value in the option. The intrinsic value does not erode with time in the same way as time value. And again, you can see within the money options how you have more of a linear approach. It's not like here where it's the last 30 days and you get that big jump in theta. So in summary, theta decay and moneyness. Moneyness, of course, if you remember, has to do with being, at the money, out of the money, in the money. The impact of theta varies with the options moneyness. At the money options with the highest proportion of time value are most affected by theta in absolute dollar terms. Out of the money options, while having a lower absolute theta, can see more significant percent losses due to their lower overall value. In the money options are less impacted by theta due to their intrinsic value component. Theta's value for option buyers versus sellers. So here's characteristics of theta continued. the value of theta for option buyers versus option sellers. It's negative for long positions. So for buyers of options, they're long. Theta is negative. Each day that passes, it eats away at the option's extrinsic value, or the value above the intrinsic, the real value, assuming all other factors remain constant. It's a positive. Theta is positive for short sellers, for sellers that sell options. Theta is a positive number, and option sellers benefit from the passage of time. As time erodes the option's value, sellers can buy back the option at a lower price, all else being equal, or potentially let it expire worthless, thus keeping the premium they received when they sold the option. So option sellers benefit from the passage of time, while buyers are disadvantaged by the passage of time. So with option sellers, time decay means that the options that they've sold lose value over time, potentially making it cheaper to buy them back and make the position profitable. And also they can expire worthless. For buyers, the opposition is true. As time passes, their purchased options lose value due to theta, reducing the potential for profit, especially if the underlying stock doesn't move as expected. So let's recap this lesson here. The key takeaways. Theta represents time decay. Theta measures how much an option's price decreases as time passes, reflecting the depreciating nature of options due to their expiration dates. So impact on option sellers and buyers. Option sellers benefit from theta as it causes options they sold to lose value over time, which can be profitable. In contrast, option buyers face a disadvantage as their purchased options lose value due to theta. Now, theta's relationship with moneyness. The impact of theta varies based on the option's moneyness. At the money options often experience the most significant dollar losses in the last 30 days. Out of the money and in the money options, while having a lower theta in dollar terms, can see a more linear loss to the option price. Time to expiration. Theta's effect is more pronounced for options with shorter term expirations compared to those with longer term expirations, as time decay tends to accelerate closer to expiration. So overall, yes, you're going to see a quicker acceleration closer to, once you get closer to the expiration date. But again, it becomes much, much more linear as you get further and further out of the money or in the money. So practical implications. Premium sellers strategies like writing covered calls or selling naked puts can benefit from high theta, as the goal is to have the options decrease in value over time. Long option holders. If you're buying options, you're directional and you want to be aware that time is working against you. You'll need the underlying asset to move enough in one direction or another, the one that you pick basically, to overcome the loss in value due to theta. So in summary, theta is a crucial element of options trading, and understanding it can help traders make more informed decisions about the timing and potential profitability of their trades. It's the silent partner in every options trade, reminding us that in the world of options, time is literally money. Remember, while theta is an important factor to consider, it's not the only one. Delta, which is price movement or direction. We have vega, which is related to volatility. Rho, related to interest rates. Those also influence an option's price. Moreover, Real world events like earnings reports or economic data releases can dramatically alter an option's value, irrespective of its theta. See you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieve my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.